Hello, YouTube. The S&P has gone up by just over 20% so far this year, and we are currently up by 16.6%. This is very ominous because every single time the S&P goes up by more than 20%, 100% of the time it has a drawdown. Sometimes it ranges from as little as 4%, but sometimes it's as deep as about 30%. So as we're looking here to our yearly chart, what's so interesting is that if we look to our low from last year at 382.43, we times it by 20%, we get 458.19. What's our high of the year so far? It is 459.44, which means we just crossed that 20% threshold, and now we're going into the drawdown. But because we're only up by about 16.6% so far this year, it means we've had a drawdown of about 3% so far. So what this really does is it starts to really emphasize the importance of understanding that it could be shallow, it could be deep, and there's some clues we can look at which we've been trying to bring to you every single day for at least the last couple of weeks now. If it's going to be a shallow dip, meaning we're just going to go for that 3% drawdown, what should happen is that we just basically go sideways for about another week or two, rally up into the end of the year, into the end of the month, basically going into September, and then we go from a new high of the year. However, if we're going to be going into a crash, which means that maybe we're due for more than a 4% drawdown, maybe it's 5, maybe it's 7, maybe even, God forbid, it's 10. If that's going to happen, there is a very repeatable pattern which has happened every single time. We get a weekly pattern here, which we've identified in the yellow boxes, and we're going to give a brief update to that today. We also have economic data, which was CPI. We got a big gap up, we got a big pump, we got a big dump. We're basically closing out flat, a whole bunch of nothing or a nothing burger. We also got an update to the GDP 2 days ago and showing that we are now over 4%. So I think there is a lot for us to go through today. And finally, just at a very high level today, we can note that there's not a whole lot going on in the market today. Disney's up a little bit, but otherwise it's pretty much a flattening out day. Here's the interesting part. We look at the last 4 hours. Nothing happened. Everything is basically flat. So what does that mean? Most of the fighting happened into the open. From the open into lunch and lunch into the end of the day, nothing happened from lunch until the end of the day. So if we look at our chart now, last thing to look at here, looking at the last 1 week, there's clearly some rotation happening. And if we remove the sector to go to no group, it's pretty obvious what's happening. It's big tech, which is being sold. That's the theme that I'm noticing here. And if we zoom out to a 1 month, or basically the last 30 days, now it's a little bit more mixed. We notice that it's largely green. Some blocks are red, like Apple, Tesla, whatever this is here, AVGO, and a few other names. So it really just looks like there's rotation happening. So let's go through our two different scenarios here. But before I do that, I'm going to ask you for a huge favor. If you could please consider smashing that thumbs up and subscribing to the channel, that would be greatly appreciated. We put out stock market videos every single day, and we're trying to do our best to try to help you be prepared to conquer the market. So here we go. Let's look at our one-day chart. And to make it nice and simple, we're going to compare to the seasonality chart, because the seasonality chart only cares about a line chart. And thank you for people who comment to tell me that, look at the post-election year, yada, yada. I don't particularly care, and I'll tell you the reason why. I don't care if it's an election year. I don't care if it's whatever. I just don't care. What I care about is, what is the average over 20 years ending 2022? Why do I care about that? Well, because the last 2 years have been anything but normal. So trying to say that this election year is going to be the normal cycle, I think it's a little bit naive. And for me, it's acted as a great template to show the dips into the first part of the year, the rip into April, and really from the June low up until where we are now. So why would I start questioning it now? This is a guide. It is not the Bible. And when we're trying to assess whether or not we're going to get a shallow dip or a deeper cut, hey, if the recipe works, why do we want to start playing with it? So anyways, here we go. We got basically a flattening out here. So we got our first dip, our second dip, and then we go for the lower low. All right, what does the seasonality chart tell us? Let's zoom in nice and close here. So low, lower, flatten out. So that looks like it's a check. I would agree. I think it looks like a check. And what I put as my caveat, I think I mentioned this yesterday, is that this is all good, but we cannot breach that 50 DMA. We did not do it. We got a bearish engulfing daily candle, and we eked out a gain by closing up by 0.16. Looking at QQQ, though, the story is that we actually closed below the 50 DMA for 2 consecutive sessions. That, for me, means that there could potentially be a trend change. The bulls try to make progress by printing a daily higher high, but it got slammed and we closed up by about 68 cents. But our 50 DMA is going to be the blue number here at 368.69. And our close is 10 cents below at 0.59. Volume's also ramping up a little bit here, getting a little bit more selling. So we're getting a little bit of evidence here. It's not quite confirmed, but there's definitely some evidence. So for the daily chart, I would say that there's nothing to worry about yet. Volatility is 100% increasing. And we're noticing that the fear and greed is really oscillating between points every day. 64, 70, it was bouncing around all over today. So the reason why this matters is because if we're looking at a line chart and we note that there's not really much happening, why are we thinking so hard? We're over the short-term price. We're really starting to flatten out. And that's why I mentioned that maybe the stock market crash was over 2 days ago. And now I said that there might be a big pump, there might be a big dump. Well, thankfully, we got both. We got the pump in the morning and we got the dump in the afternoon. All right, so we understand that this so far is giving us pretty good evidence that is playing out. Let's look here to our second chart because tomorrow is going to be Friday and we're going to close out this weekly chart. So let's look here and to see if we can understand the notes that are laid out at the top before we look and see whether or not we have a crash warning, which is manifesting here. So higher hollow candles signal the expansion is continuing. Do we have a hollow candle? Negatory. Earlier in the day we did. Today we don't. So as of right now, we have a full red candle, which means the expansion is at least on pause because we got 2 full candles in a row. And a lower lows are a warning. So far, we've got 2 lower lows. And as of right now, being below 446.2, we are also below last week's low, which means we have the recipe here. The recipe is 2 red candles in a row, at least 1 weekly close below the previous candle low, and that's it. So here we have the red candle. On the red candle, we have the second one, and then we close below the weekly low. Same thing here. First red week, we close below the weekly low. Second red week, we actually, on the third week, we actually closed below the weekly low. And now here we got that same thing happening. So what does it mean? It means every single top, even back to the all-time highs, we have the exact same warning. So what's really difficult about where we are right now, and the reason why I have a big question mark on my chart is because, frankly, I just don't know. I'm seeing evidence this is correct. I'm seeing evidence this is correct. So what do? Man, I just wait for the confirmation. It seems simple, but man, can't we have the patience to see if we're going into a big crash? And that's why we say it's a warning. Lower lows are a warning. Confirmation for me really comes when we start seeing stuff like this. Multiple red candles in a row, being below the previous weekly low. And that's like really important. So if we think about all this, what does it mean? It means we've stopped going up at this angle of ascent. We are questioning whether we're going to go to the 100% retracement or back to all-time highs, or if we're going to come back down here to 432. That's the big test for me. If you look at the daily chart, where did we perfectly reject today? Oh my goodness. The high of the day is 451.7. What's the Fibonacci area? It's 451.27, which basically tells you that we hit the Fibonacci or math area, which we've been talking about, that 70% retracement, and we reject it. It's that simple. We hit the level, backed off, failed to hold it. So that's what we see right here with this upper wick. So in terms of trying to understand the price action, well, for the bulls, what we want to see is that we don't go any lower, right? Maybe a smaller lower low next week, but basically we cannot lose this 50 DMA, and we need QQQ to start leveling off. Otherwise, it could be fading down here to about 360 because it's lower uptrend. It's not really that much lower. It's about 2-3% more down, but it's going to tell us that, well, maybe if we're starting to go for a -5, maybe a -10, the pattern that I laid out a while ago is pretty strong, and it's kind of hard for me to ignore right now if we start closing below the weekly low. So now let's talk about the economic data today. So the reason why we gapped up is because inflation actually came in below the expectation, but a little bit higher than before. So to make it really simple, red is good, green is bad. So because CPI came in red or missed, and so did initial jobless claims, the market liked that. The market cheered, the market rallied, it pumped the open, but it failed to hold it. And that's because the bears were right there, ready, willing, and able to sell it. The market's also maybe a little bit too strong right now, where we're starting to question whether or not we're going to have to raise interest rates more. 4% GDP is 2% or 100% above what we normally do. A normal GDP print is around 2%. That's what they call normal growth. 2% is normal. And the challenge here is that after getting a 4% print, We look here. All right, 4% print, 3%, right down to zero. 3% print, right down to zero. We get a 5% print, right down to zero. It's not good. 6% print, zero. 3% print, 0.1 point something. So it's going to be very hard on a quarterly sequential basis, which means next quarter to beat this 4.12, which means we could be going into recession, but that's like a long ways off. We're only going to know that in 6 months. So with that said, I highly encourage you to subscribe to the channel if you want to tune in with us tomorrow. Otherwise, you want to chat with me, Justin. And if not, I thank you so much for watching. And our weekend video is now queued up here on the left-hand side, which tells you, is it time to sell? If the bears are back, there's a very clear template. If not, thank you so much for tuning in. Thank you for your support this week. I look forward to seeing you tomorrow or for our regular scheduled upload on Saturday. Thank you so much.